Hello and namaskar viewers, I am Sanjeev Pandya welcoming you to this week's edition of the Business Talk with Ajay right here on ITV Gold. This weekly show gives you all the information that you need to know when it's in the business industry. That means it's a business talk. What we do that in this season 2 and episode number 2 is that we pick out a business where mostly South Asians are successful in those businesses, but we need to know inside and out of the business, what really requires for the business, what is the business all about, what are the challenges that they face, how are the investors come in that kind of business, and how they make money. So all these things which are very, very helpful for business owners like you, and you will find this very interesting. So that's what the Business Talk with AJ show is all about. Every week we pick on a different topic and we bring you in-depth information about that business. And we're so grateful to Sai CPA Services for sponsoring this show. And Sai CPA Services is a full-fledged professional accounting firm located in the state of New Jersey, multiple locations in Jersey. They can be reached at 908-380-6876, or you can visit their website, which is saicpaservices.com. Sai CPA Services believes in doing taxes right. So do your taxes right, and for that, even though the tax season is over, but it's never over because there's always something to do. Somebody has to file an extension, somebody has to follow up an extension, or somebody needs to clear the past tax returns not filed, or somebody is into IRS tax audit. All that matters, Sai CPA Services will make it really easy and simple solution for you. So we thank Sai CPA Services for sponsoring the show. With that note, I'd like to welcome Mr. Ajay Kumar, CPA and MBA with over 30 years of experience, and of course with Sai CPA Services to the show. Ajay, welcome to the show. How are you?
Thank you, Sanjeevji. Thank you for the kind introduction. I'm doing well. Thank you.
All right, good. Now it's really gearing up. It's really exciting to talk about different businesses.
Absolutely.
We talked about IT business, and that was really in-depth information that you gave.
Absolutely.
And this week we're going to talk about real estate investment, realtors, and the real estate investors, how they come in and how this real estate business, which has been very, very profitable, and many South Asians are in it, and they are really enjoying the profit of this business.
Absolutely, Sanjeevji. Very well said. 70% of the top 1% wealthy people are there because of the real estate investment.
Wow.
That's amazing. If you are in US, if you are in this country, the easiest way to become a millionaire is through the real estate route, or that's what the statistics shows. In this show, not only we'll talk about the real estate investment, we'll talk about the realtor, what expenses you can claim, what 1031 exchange is all about, what self-directed IRA, how do you use your retirement money to invest into real estate, how do you find money, what are the pitfalls, what are the tax pros and cons for each situation. So stay tuned. We'll bring a lot of information to you.
So these are the topics going to be covered in this episode. So first, let's begin with realtor, because of course real estate business and realtor has to be in there. So let's
Absolutely.
talk about realtor.
So a realtor is loosely defined as a person who is doing it for full time. It could be a realtor broker, it could be a realtor associate, a real estate person who is doing it full time as a job. This is considered as their active business, as opposed to somebody who is doing it part-time or who has a full-time job or a full-time business, another source of income, and investing into real estate as passive activity. So we have tried to separate out real estate investor and a realtor loosely by saying this is an active business professional as opposed to somebody who is passively investing into this activity.
Okay, so that's a realtor. Now, of course, when there's a realtor, and one thing I want to say that in this show, the Business Talk, and in this series, there's not going to be one episode where we don't have to talk about an investor, because investor comes in every single business.
Every single business, you're right.
Exactly.
100%.
So real estate obviously is not an exception as well. So let's talk about real estate investor.
So a real estate investor is somebody who wants to grow their wealth, who wants to invest money because they have made some money through their job, through their business, and they want their money to be working for them. So they invest some money, 20%, 30%, whatever the minimum down payment they have to be bringing in, Rest of the money is typically funded by a third party, a bank or a financial institute, and then this real estate grows in value, so hopefully they can sell it at a higher price and make some money out of it.
All right, so rental property is such
A rental property, it could be commercial, could be
commercial
residential,
property. Okay.
it could be rental property, or could be something that's not creating the rent right now. You just buy a farmland and leave it there, hoping that in year, 2 years, 3 years, you will have the commercial zoning, or people will start coming over there to live over there, and it grows in value.
All right, so now the realtor and real estate investors that we touched upon. Now let's talk about the typical expenses for real estate investors in this category.
Absolutely. So when you are working as a realtor, a lot of these expenses are considered as active expenses, as opposed to when you are a real estate investment. So when you are a realtor, you will typically use Schedule C on your tax return, as opposed to Schedule E as a real estate investor. And the differentiation is, as a realtor, the losses that you have in this real estate business can offset your active income. Now, in order for you to be able to claim it, you have to have active participation and material participation. So active participation is defined as somebody who is actively full-time working on this business. Material participation is defined by the number of hours you are putting in. You have to be putting in at least 500 hours in this activity as such to define it as a material participation. Again, the differentiation factor is, for a realtor, for an active participant, you can claim the expenses against your other income, and typically these things go on Schedule C for realtor.
Okay, all right. So now, obviously, in every episode we bring in a tax angle, because Mr. Ajay Kumar, who's a CPA and who's part of Science CPA Services, right? So now let's talk about taxes, especially 1031. How does that really come into play with this business?
Absolutely, I'm glad you asked. So if you take an example, just to simplify it, if you bought a real estate property for $100 and tomorrow you are selling it for $300. In this case, you have a capital gain of $200. You bought it for $100, you are selling it for $300, so capital gain is $200. Depending on if you waited for a year or more, it could be short-term capital gain or long-term capital gain. If it's under 1 year, less than 1 year, then it's short-term capital gain, which is typically taxed at your regular income tax bracket, which varies from 10% to 37%. Long-term capital gain, meaning you capped the property for more than 1 year, are typically capped at 20%. But nonetheless, going back to our example, if you bought something for $100, sold it for $300, now you have a $200 of capital gain. And let's assume in this example is long-term capital gain, you have the highest income tax bracket, so maximum you owe is 20% taxes to IRS. But hold on, how do you avoid these taxes? How do you not pay these taxes? And that's where the 1031 exchange kicks in. If you reinvest this $300 to the new property,
yes,
then the government sees that you are not really selling it, you are just exchanging your initial property for the new property. There are rules around it, Sanjeev ji. The new property has to be like kind, meaning if it's a commercial property, it has to be commercial. If it's an investment property, it has to be investment. You cannot be selling your primary home and buying the investment property, or vice versa. Also, you have to identify the new property within 45 days. You have to invest or close that property within 6 months. So there are timelines, there are rules around it. You cannot be touching this money. The money from selling of the first property must stay in the attorney's escrow account. Again, the point is there are a lot of rules, regulations around this 1031 exchange, but essentially the definition is I'm not selling it, I'm just exchanging my property, so I should not be paying any taxes. So you can avoid paying taxes on real estate capital gain, short-term or long-term, by reinvesting this money into another property of similar type under 1031 exchange.
All right. So in this scenario, in 1031, if I understand correctly, obviously, it has to match commercial to commercial, rental to rental, and so on and so forth. How does depreciation come in effect in this scenario?
Well, the depreciation is a factor of taxation. When we compute the taxes, depreciation is typically an add back to the cost basis. But in this case, the depreciation wouldn't factor in because we are exchanging the property. I'm not selling it. So if you are selling it and you want to compute the taxes, long term or short term, then we'll see how much was the depreciation, and we'll try to add the depreciation back to the taxable income. But in this case, depreciation wouldn't factor in.
Okay, all right. So it won't factor in, but these are the rules that somebody has to keep in mind. Now, what because you have a variety of clients that sign CPA services and you cater to all kinds of business owners, right? What have you seen? How long a person should hold on to the property if it's a rental property? Is there some suggestion or guidelines that you can give that don't hold on to it for forever and ever? After certain years, they should give it up and get another property. What do you suggest?
I think there are two types of theories around it. I say find the property that you call flagship property, meaning this is the property, this is my retirement plan. I bought an 8-apartment building and my social security income is not going to be sufficient. I'm hoping before I retire, I'll pay off this property, so the rental income from this property will feed my retirement.
Correct.
That's called flagship property that you keep forever. On the other hand, we call it fix and flip, where you buy the broken up property,
yes,
you have somebody fixing it, and then you try to sell it ASAP. But a lot of these property takes 6 to 9 months to fix.
Yes.
So then we advise, if you have already invested 9 months, depending on your income tax bracket, it may make sense to wait for another 3 months. So you can avoid the short-term capital gain, make it long-term capital gain by pushing it over 1 year as opposed to under 1 year, unless you're making a lot of money out of it.
That's a very, very valid and a very true point. With that note, we're going to take a short break. When we come back, we're going to continue our conversation. Remember, this is the Business Talk with Ajay, and this week's topic is real estate. Welcome back to the second half of the Business Talk with Ajay. This week's topic is real estate. As you know by now that every week in this show, the Business Talk, we pick on a business and Ajay gives in-depth information about the business, in and out, entrance, exit strategies, and what are the challenges and everything that you really need to know. Now, in the first part, of course, we talked about realtor and the real estate investors. We talked about that. Now, and then we also talked about the tax. Ajay explained tax implications, Form 1031. Now, here we're going to go into this self-directed IRA matter.
Absolutely. So, self-directed IRA, as the name indicates, me directing my own retirement account. This is one way to fund the real estate investment. You have a lot of money into your retirement account, but you don't have enough cash flow to buy the real estate. You can use your own retirement account money to invest into the real estate. The way it's done is by creating a self-directed IRA account where you form an LLC typically. There are separate companies that will take care of the self-directed IRA LLC. You bring the money from your retirement account into this LLC. This LLC keep investing, keep making money. The only caveat is you cannot use this money for your own personal use. The money must stay into that LLC. And once the LLC, you close the LLC, it should go back to the retirement account.
Okay.
Meaning the retirement account has certain restrictions on when you can take the money out before certain age.
Correct.
So when you are using the retirement money to fund the real estate investment through self-directed IRA LLC, you must maintain a Chinese wall. You must maintain a distance. You cannot use the money for the personal benefit.
Okay. All right. So that's a self-directed IRA. So Ajay, I tell you what, with self-directed IRA, that you explained that you can invest money from IRA into real estate. Let's continue the other investment options, where they can get fund to invest into real estate. So let's start with traditional mortgage. That's the number one
Absolutely.
thing.
That's the easiest thing. You have a good property that you're eyeing. You have to bring in 20%, 30%, depending on if it's residential, commercial, maximum 30% down, and rest of the money is typically funded by the bank if you have good credit history, and especially if the property has enough cash flow coming over. So the number one way to have the property funded to buy the real estate is through traditional mortgage. In many cases, traditional mortgage is not an option because either you are over leveraged, or sometimes the credit history is not good, or you're buying a property that will not create the cash flow. In those cases, you may want to go to hard lending.
Hard money lending,
Hard money lending, where there are private lenders who will give you the money Typically, they are slightly higher interest than the typical
Yes.
mortgage, but these people don't really traditionally look for the tax return. They typically don't have as much concern about the credit history.
Correct.
So easy to get, but a little bit more expensive when it comes to the private lending or the hard money lending. The other way you can fund the real estate is by family and friends. You create a group, create a partnership. Hey, I only have 10%. You want to be partner?
Crowdfunding.
Crowdfunding is generally with the crowd. We prefer family and friend or the partnership funding
partnership,
first
yes.
before we get in the crowdfunding. Crowdfunding is typically used when you're buying something worth millions of dollars, when you need a lot of money.
Yes.
That's when you go to the crowdfunding, because in crowdfunding you have to create a project, put it publicly so everybody can see through it.
Correct.
And that's when you expect 100, 200,000 people giving you 10,000, 20,000 each.
All right.
That's slightly for bigger concept.
Bigger brand. Okay.
Bigger properties, not for smaller properties. So there are a lot of companies who do the crowdfunding.
And I want to bring in the most important, one of the most important ones where I know that many of our community members go for it, SBA loans.
Absolutely, 100%. SBA loan is the best thing you can do. It requires you to bring as low as 3% down payment, but SBA loan has a strict requirement. Very, very stringent requirement. Good credit history is needed. Lot of paperwork, and it can take as much as 6 months before you get the SBA loan.
Okay. And then there are other categories: seller financing, then lease options, and then home equity loan.
Absolutely. If you're thinking about buying a real estate and you have your primary home where you have created some equity, that could be another option. Take some home equity to invest into the real estate. You can also consider a lease option, meaning you start renting the place with an understanding from the landlord that after 1 year, 2 years, 3 years, I'll keep it on the rent, but then I have the right to buy, lease to buy option. Or along those lines, you can have seller financing, meaning I'll buy it from you instead of going through the traditional mortgage. You are my bank, you are my lender, Mr. Seller, and I'll give you the interest back at certain rate.
Okay. How convenient, how often they go for REITs, real estate investment trust?
Well, that concept is when people don't want the headache. They want the benefit of the real estate investment, but they don't want the headache of collecting the rent, fixing the property. Real estate investments are the REITs are companies. They invest into hundreds of these properties and then they try to sell the shares. So there is a management company investing into hundreds of properties. They created a portfolio, let's say $100 million. Now they're giving 100,000 shares for X amount.
Okay.
And now you can be part of it where you have some benefit. Somebody else is doing the management for you. You have the exposure to real estate investment, except you don't have to do a lot of work yourself.
Okay, so now, obviously AJ explained all the different categories where you can get funding to buy the real estate property, to get into the business. Now let's talk about challenges. Before the end of the show, we must talk about challenges, because when there are good things, there are also not good things also, right? So talk about these challenges. What are the challenges faced by real estate industry?
A lot of people don't realize it. Having the right entity type, you typically don't want the real estate investment under your own name. You want to form an LLC, and not knowing any better, we see a lot of people having the real estate investment either under their name, where if somebody falls down on their property, they are sued directly, or they end up creating a corporation where there is more strict requirement, compliance requirement, payroll requirement. So the ideal structure for having the real estate investment is typically an LLC, limited liability company. Yes. So make sure if you are getting into the real estate investment, before you buy the property, form the LLC, so the title of the property that you are buying is under that LLC.
Okay, AJ always brings in a tax angle for any business conversation, besides the tax talk show, and that's really, really important. So having a right entity, it's extremely important. Now, what about, tax deferral strategies?
Absolutely. So when you are buying a lot of properties, making sure that you are tax savvy is extremely important. So for example, if you bought a property and you are getting a good price, you are selling it, but deep down in your heart, you know that you are going to buy another property for this money, then as we discussed in the first segment, consider 1031 exchange. So you can defer the taxes. If you know you are selling this property and it's been 10 months, then see if you can push the closing date for another 2 months to get the long-term capital gain. If you have to pay the taxes, at least you are not paying the tax on the regular income tax rate, you are paying the tax rates on the long-term capital gain. So be tax savvy about it. Be focused on the bottom line as how much is really costing you.
What's the really typical difference between a short-term capital gain and a long-term capital gain?
Half and half.
Okay.
So in a general scenario, a rule of thumb is your long-term capital gain tax will be half of your short-term capital gain tax at a high level. So just to give you an example, the tax rate varies from 10% to 37%. Short-term, the regular income tax rate, while the long-term capital gain tax rate maximum is 20%. So for most people, if you are making less than 600,000, it's 15%. If you are making less than 80,000, it's 0%.
Okay.
So the rule of thumb is for most people who are in the real estate business and they're making good money, the rule of thumb is the long-term capital gain tax rate is going to be half of my short-term capital gain tax.
Okay, all right. The another important things that people really should make a note of it, and many people fall off the track because of this reason, that's underestimating repairs and maintenance.
Absolutely, 100%. I'm glad you reminded me. So repair and maintenance are considered period expense. You have the right to claim it on the expense side in the year it incurred. Improvements, on the other hand, if you're putting a new bathroom, if you're putting a new section in the house, that has to be capitalized, that has to be depreciated. But not knowing any better, a lot of people end up putting the repair and maintenance into the capital section and don't get the right benefit. So make sure you understand the difference between repair and maintenance, you understand the difference between the improvements, and do the right thing. Be tax savvy when it comes to the real estate investment.
Are there any losses that rental property owners can deduct on their tax return?
Absolutely, absolutely. So there are a lot of rules around it: active rules, passive rule, material participation, non-material participation, being the realtor, being the investor. So make sure you are thinking about it and how to get the maximum advantage. I'll give you an example quickly in the end of the show. So for your primary home, the maximum property tax you are allowed to claim is $10,000. You cannot claim more than $10,000 in property tax. Even if you are paying $20,000, maximum benefit you get is $10,000. But for your real estate investment, there is no such limit. If you are paying $20,000, you claim $20,000 in property tax. Another example, for your primary home, if your mortgage amount is more than $750,000, you don't get the full benefit of the interest.
Yes.
For real estate investment, if your mortgage is $1 million, you get the full benefit of the interest that you are paying. So there are a lot of smaller
because government wants you to keep investing into real estate and investment properties and rental properties. Anyway, Ajay, thank you so very much for that in-depth information in the real estate category. That was the topic for today's Business Talk with Ajay. And when we come back next week, same place, same time, we're going to have another topic for you. Till then, I am Sanjeev Pandya, wishing you all happy and smiley days ahead. So long.
Thank you.